Well, good morning, everyone. Welcome to AllGen Financial's quarterly updated market review. Today is April 17th, 2025. And congratulations. If you're here today, you've survived mayhem in the first quarter of in so many different directions coming from us at so many different ways. But we're going to talk about some of that and how specifically they affect the market and what we think that might do to markets and the economy moving forward. So if you've been here before, you know the drill. We're gonna spend the next 45 minutes to an hour talking about the market. Jason reflecting about what's happened, what we're seeing, and what we're expecting, and what we might be doing in anticipation of what we're expecting. Also going to be doing some questions. We always like to get your questions. So at the bottom of your screen, and this is more so for those who don't know the drill. There's a Q&A box. The raise hand should be X'd off, but you can put Q&A type of questions there. You don't have to wait till the end. We will wait till the end, most likely, to ask the questions or address them rather, just so that Jason can make sure we get through all the slides. If I think there's something that's really time sensitive in terms of very specific to a slide he's showing, I might just interrupt them. But for the most part, we try to wait till the end to make sure we get to all the materials. But please feel free to ask the questions anytime throughout the presentation, just so you don't forget it. I know we had one or two come in even before the webinar in anticipation, so I'm glad we have some eager beavers. And then at the end, before the questions, we'll go over some stuff that's happening more from a timeline, deadlines to be aware of, financial planning type of information. So if you don't mind, we're gonna get started, and we typically start off with something a little fun, which is a couple of polling questions, just to make sure you guys are getting your stretches in. So if we can we do a serious one and a more lighthearted one. So if we can start with the polling questions, that'd be great. If we can queue it up. I'll wait for our queue person to queue it up. There it is. So investing in 2025. How do you feel about investing at this moment with everything that's gone on? Are you cautiously optimistic? Are you playing it safe? Let's stick to cash or bonds. Taking more risk for bigger rewards. Time to buy. Or you know what? I'm just gonna avoid this altogether and just sit on the sidelines. So there's no right or wrong answer. This is just a more temperature gauge to see where people are at. Again, Jason's going to address our approach and our strategies, and understanding that we understand everybody's different, and there's some people that are more aggressive, more conservative, and we have portfolios for all that, and depending on what your financial plan says you need. So I'll give you another second to answer the question, and let's see how we're doing. How is the audience feeling in terms of the market and investing right now? So interesting. We have a house divided. So we've got about a third cautiously optimistic, a third take more risk. So you got a couple of different extremes, and almost a third sitting on the sidelines, with very few people sticking to cash or bonds. Okay, so we have a wide array. They're everywhere right now. So thank you for that. Let's get to another question now, if you don't mind. Queuing it up, please. Okay, something a little bit more lighthearted. What's your summer 2025 vibe looking like? Okay, we're approaching summer, end of school's coming, graduations, etc. So are we thinking beach days and tropical drinks? We're thinking road trips and national parks. Are we feeling catching flights, not feelings? I don't know who wrote that answer in there. And homebody mode, staycations and AC. What's your vibe for summer vacation? I know where Jason lies on that one. He's more of a road trip national park type of guy. I don't know where I'd probably be catching flight type of guy. I'm only answering for me and Jason because we don't get to participate. So, all right, let's see what the audience says. We've got, they're almost evenly spread across the board. We've got some for everything. So, and that's the beauty of this. So hopefully with some good planning, we're paying for these vacations cash, right? And not getting into debt to do it. Sorry, I got to do financial planning plug in there. But that being said, let's jump into the meat of the presentation. Jason, please tell us what's going on.
All right. Thank you. Hello, everyone. Let's jump right in. We got a ton of slides today, so you nerds are going to love it. And then some of you guys, some of the rest of y'all, your eyes may glaze over. So I'm just going to jump straight in here and look at this first slide, which kind of gives us an overview of where we are year to date with all the different markets. And pretty crazy. Obviously, in the news is how much the stock market has gone down. And if you see here in the bottom two lines, that is accurate. The S&P 500 is down 9.3%. And small caps are actually down 17.4%. However, not a lot of times in the news is some of the other areas where you see international stocks are actually up 4.6% and bonds are up 2.2%. And then gold is actually up 27%. And it came off of a year where it made 28% last year. So big difference between kind of what happened last year with stock markets up a lot, bonds not doing as well. So that kind of flip-flopped, but we'll talk more about that. I want to start us off with sentiment. So sentiment, when you look at it from the standpoint of kind of stock market and different indicators to follow, sentiment basically is a way to kind of measure people's feelings about the market. And when you look at sentiment, you look at it from the standpoint of usually during extreme times in sentiment, the crowd, if you will, the herd-like behavior is usually wrong and is on the wrong side. And that's typically the case at an extreme. So the first one I want to show here is what's called the VIX, and the VIX measures, it's also known as the fear indicator, but it basically measures fear and complacency. So when the VIX spikes higher than 40, it is in an extreme position. So I have a chart going back here to about 1985, 1986. And the red dots here, every time that the VIX has actually gotten above actually gotten above 50. And so you can see we did reach 50 recently. And so all these red dots are when it reached above 50. As you can see in the bottom section here, over the next 3 months, the win rate, which means how often the market was up, like if you look at the 3 months, for example, it was only up 43% at a time, and the median returns were down 3.22. The average returns were down 0.81. So that doesn't look that great. That would tell me that there's a lot more volatility to come. However, look at what it shows for 1 year later. So if you can withstand the short-term volatility here, look what happens 1 year later. 99% of the time, markets were positive, and average returns were 28%, and median returns were 23%. So that's the first sentiment one. The next sentiment indicator is looking at consumer confidence. Consumer confidence is basically a survey that says it surveys all the consumers out there, the population in general, and kind of measures if they're comfortable buying things, if you will, and how they feel about kind of the market in general. So looking at it from a contrarian standpoint, when it gets low below this green line like we are now, that's typically a good time to buy. And when it gets high, a lot of times that means you're probably kind of in a euphoric bubble-like kind of territory. So we just recently hit a low here. And when that happens, if you look what 1 year later, 2 years later, and 3 years later, so 1 and 2 years later, it's up 92% of the time. 1 year on average, or median returns of 17.5%. 2 years on average, a cumulative return of 34%, which is kind of about an annualized return of about 16%. And then 3 years later, 100% of the time, markets were positive with a cumulative return of 47%, which is about 14%, 15% compounded rate of return. So that would say, contrary to what most people think, when consumers get really nervous and they're not wanting to buy anything, that would be bad for the market. However, history shows that when you reach those extremes, that you've probably gotten close to a bottom. And while we're not necessarily calling for a bottom right now in the recent drop, what we are saying is that if you look at these historical timeframes, it can be different than what you would think. So the last one here, and I'm going to share this one at the risk of being condescending, and it's not my desire to be condescending with this, but this is more of a sentiment from the standpoint of this is an industry term using industry wording, which is smart money and dumb money. So smart money would be considered like institutional money, large shareholders, and then bigger money, pension funds, that type of thing. And dumb money would be kind of your average investor, if you will. And so you have the blue line, which is considered the smart money, and you have the red line, which is considered dumb money. And so when you look at this, if you see like the pandemic, for example, when the market fell really fast, dumb money got really scared. But smart institutional money got really optimistic. And so above this dashed line would be a high level of optimism. Below this dashed line is a high level of pessimism. So you had that also in the bottom of 2022. And then right now you can see we've reached pretty extreme, actually the highest point of optimism for smart money and one of the lowest points of pessimism for dumb money in a long period of time. And it typically, when that happens, you have, I'm sorry, Paul, you just got me a little distracted here. Are we doing the samba over there? What are we doing? Anyway, just keep on going. I'm a visually distracted, easily distracted type of person here, and I see Paul doing some type of salsa. I guess he's more Puerto Rican Cuban. That's salsa, not samba. Samba's Brazilians, but anyway. So look, I'm making the point here that in general, you have if things are different than what most people would imagine in terms of when people get scared, markets are typically closer to a bottom. But smart money is looking at that of, hey, things went down, things are on sale, we should be buying right now. So I point this out for a lot of reasons. One, market just went through a pretty extreme drop, especially in such a short period of time. However, if you look here on this chart, historically, this is looking at kind of the largest intra-year decline of each calendar year. So the red dot would point out the largest intra-year decline for that particular year. And on average, over history, now we're actually going back to at least 1980 here, you can see the average intra-year drop is down 14%. And so we just had a drop of 19%. You can see a drop over here of 25%, 34%, obviously the financial crisis, 49%. But I point this slide out because you need to expect that at some point during any year, you're going to have some volatility. That being said, the markets are typically positive about 72% of the time. Even if you look here, 34 out of 45 years, the market did end up positive, even after that large intra-year decline. So you can see like a decline like 1987, which was the crash of 87, largest intra-year decline of almost all of these was down 34%, but it ended up the year positive too. And so there are plenty of times where you can have a large inter-year decline, but still end up positive. So I say that not saying that I think that markets are going to end up positive this year, but just because we have a large decline does not mean that the markets are going to continue to decline, which is the same thing that sentiment was pointing out. In fact, the opposite is usually true. After a large decline, you typically get a large rally, which is the point of this slide. And I showed this recently in a market update when the market was falling, but there is a large cost of the average investor trying to time the market. So if you try to time the market, a lot of times people will want to sell after a drop. But everyone kind of knows the old Wall Street adage, which is buy low and sell high. However, when they get scared, they do the opposite. They sell low, and then they don't even buy until they're comfortable buying in again, and they're not comfortable buying in again until the market gets high. So they're doing the exact opposite of kind of the old Wall Street adage of buying low, selling high. And this chart confirms that. So if you look at, if I have $10,000 invested over a 20-year period from January or 2003 to 2022, if you just kept it invested in the S&P 500, you made $64,000, or that it ended up being $64,844. But if you missed the 10 largest days, you only the portfolio was only $29,000, and you actually ended up losing money at the more large days you missed. But the reason I also want to point that out is, in the timeliness of this, is that if you see right here, this little bullet point, 7 of the best 10 days took place in bear markets. So if you see here, when were the best 10 days, look at these years: 2008, financial crisis, pandemic, financial crisis, pandemic, financial crisis, financial crisis, financial crisis, financial crisis. So those were all during difficult time periods, and that's usually when you get the largest rally. And actually, a few days ago, or in the kind of the middle of last week, the market rallied 10%, which is now ranked number 3. So after one of the two biggest, or the the fourth largest 2-day consecutive drop in like the last 70 years. You had the third largest 1-day rise in the last 20 years. So it's super important. While everything is, we're built with a fight or flight mentality. So sometimes when the market drops as much as it does, you get scared and you want to sell. But I would just encourage everyone to kind of keep the long-term picture in mind, but also know from a statistical standpoint, usually the best market returns come right after a big drop. So it's not usually a good idea to sell right after a big drop. And just kind of taking this with a little bit more of a long-term mindset, you can see, here's different kind of range of returns on different asset classes. So you have like stocks on the green here, and then you have bonds in blue, and then just kind of a 60-40, maybe like what would be considered like a moderate or a balanced portfolio. You see the range here in gray. Well, in a 1-year time frame, kind of more of a short-term mindset, you can see that on the downside, stocks had a kind of their worst time frame was down 37% for any calendar year. But then you also had already rolling 1 year. But then you had its highs, it can make it at 52%. Bonds had a drop of 13%, but have made as much as a 33%. And even the balanced portfolio here actually was a little bit more volatile than the bond side, but a lot less volatile than just a pure stock portfolio. But what I want to focus on here is looking at the 5-year period. So if you look at the 5-year period, you have paints a different picture. There was never a 5-year period going back to 1950 where a balanced portfolio actually had a loss. In fact, the lowest returns over a 5-year period were down 1%. And you can even see from the standpoint of stocks and bonds, while they have had negative 5-year periods, the negative 5-year periods were down 2% on average. So, and then if we get out here to a 20-year period, there's never been a 20-year period where stocks, since going back to 1950, were negative. In fact, their lowest returns were 6%, and bonds' lowest returns were 1%. And if you look at a balanced portfolio, their lowest returns were 5 over a 20-year period, highest returns of actually 15. So all that to say is, one, if you're diversified, and this is just looking at stocks and bonds, but if you're diversified, you tend to reduce that level of volatility. And there's never been a 5-year period where a stock bond portfolio going back to 1950 has had a loss. So hopefully these little nuggets you can keep in mind when markets take pretty extreme drops and everything inside of you is telling you to cut the losses or to run. So kind of getting a little bit more technical now, if we're looking at the market from a fundamental standpoint, and specifically looking at the S&P 500 US markets, and this chart here shows you the forward PE ratio of the S&P 500. And so kind of the 30-year average is 16.93, which is this green line right here. And you can see most recently, before the market declined, we hit the third largest overvaluation or high valuation point in the last 30 plus years. And if we were to go back even further, this is one of the highest valuations that the market was at in a long time, outside of right before the pandemic and the tech bubble in the late 90s. So a lot of people want to point to tariffs and as the reason for the market dropping, and certainly that could have been a catalyst. But you also had a lot of things that contribute to it. If you have a stock market that has extremely high valuations, it is more prone to risk or to a drop. And it's not just the forward PE ratio, but if you look at pretty much all of these, the CAPE, the dividend yield, price to book, and price to cash flow, without getting into the details of what all of those mean, all of those different valuation metrics are above their 30-year average. And in some cases, like price to cash flow, they're at 1.3 standard deviations. Whereas you can see here, this is 1 standard deviation from the PE. So all that to say, it is quite expensive on every single one of these metrics. Now, since the market's dropped, valuations have dropped. Now, I will point out when you go into really difficult times, and I'm not saying we're going into that, but if you do, a lot of times it doesn't just pull back to this average. It will go beyond that average. You can see it in a really extreme time in 2008, it pulled back significantly below and valuations became really cheap. But even like the pandemic, when you had that big quick drop over 1 month, it didn't just pull back to the average. It went significantly below the average. So if we did go into a difficult market, we're not saying that it would just go back to the average. You'd probably have a short-term time period where it go below those averages. But then the smart money or the people out there, the value investors would be looking at that as a really, really good time to get in the market. So I just show this slide to say, one, valuations are still pretty expensive, but they have come down quite a bit in the US stock markets. Now, one area of the stock market that was higher than the other is growth stocks. So growth stocks, your large kind of technology stocks, they went up more over the last 5 years, but especially like last year, than value stocks. So the gray line being growth, the blue line being value. So you can see here that the growth had a larger return over that period where stocks were going up. Value was steady, but then you look at the drop, and it dropped from way above value to way below value right here, which was a much bigger drop. Now, and then from point to point, values actually held up better, even though growth stocks really outperformed over the last year. And then just looking at it year to date, you can see growth is down 10%, whereas value is down 5%. And there's been points in time, especially when the market was much lower, where that has been even a bigger difference. Growth rebounded a little bit with the market bouncing back recently. So this looks at it a little bit more into the minutia of, from a sector standpoint, what have been the returns. And you can see the defensive sectors, consumer staples, utilities, and healthcare. And consumer staples sometimes called consumer defensive, but those are things like food, hygiene products, things that you would buy no matter what the economy is doing. It's your kind of your everyday consumer things that you would buy. So those are actually positive. And a lot of times that is in the value side of the stock market. Whereas kind of the sexy area, technology, has taken the biggest hit this year, down 13.8%. And you can see consumer discretionary is down 15%. And just a little asterisk here on the consumer discretionary, 40% of that index is made up of Amazon and Tesla. Which those two stocks have, someone would kind of put those two within somewhat of the technology side as well. So that technology area has definitely taken a bigger hit this year. And all that to point out, this is a chart that we referenced for quite a while. Like if you look at the S&P 500 as a whole, it's down 10.4% year to date, had some really good returns in 23 and 24. And there was a slide that we would point out quite often that the Magnificent Seven made up a large position of the S&P 500, close to 40% at its peak. And that was a warning to our investors, and even what we did to our portfolio, that usually when you get a larger weighting of a small number of stocks in the S&P 500, it definitely increases the risk of investing in the S&P 500 because it's made up of that. In this case, it was made up of a large portion of that was the Magnificent Seven. So like year to date, if we were to take out the Mag 7, the S&P 500 is down 4.3%. But the Mag 7 itself, and for those of you who don't know the Magnificent Seven, that's kind of your Googles and your Teslas and your Amazons and your Nvidias and your Microsofts and your Apples, kind of the main tech names. So the Mag 7's down 18.6%. All this to say, it's great when you're in those stocks when they're going up a lot, and we did own some of those, and we still own some of them right now. But you don't ever want to get too overly exposed in one area. As your grandma always used to say, don't put all your eggs in one basket. And you don't want to do that with, especially that becomes more important after that basket, if you will, has gone up a lot and valuations have become very expensive. So if we look here, kind of transitioning a little bit, and a lot of the talk recently and concerns have been over tariffs. So if you look kind of what are the sectors that would be most affected by tariffs, and look at what's number one, tech. So with tech being the largest percentage of foreign sales, that you can kind of see too why the Mag 7, which is mainly technology, and why the sector is down this year, because that's what's going to be affected the most by tariffs, as well as materials and consumer services. But you look on the other end, utilities, it doesn't really affect much. and some of the more defensive names like healthcare, for example, that holds up, or it's not as exposed to foreign sales, but still a third of it does have foreign sales. So as we kind of look at more of the international side of the market, I had been pointing out, or we had been pointing out that, while S&P 500 seemed very expensive historically, international stocks have become really cheap. They've been, in fact, trading at one point recently below 2 standard deviations of a discount to the S&P 500. And that's like a 60 or 70-year low of that valuation metric. So when you get a cheap area of the market like that, international, it's hard to know exactly when the bottom will come and when that area of the market will outperform over the long run. But I will say that usually if you take a longer term time frame and say, hey, international stocks are at an extreme discount to US stocks over the next 10 years or over the next 5 years, if you look at kind of those averages historically, then they do tend to outperform. So we have a pretty good percentage of our portfolio in international. It's certainly held up better recently. Part of that's because the dollar has gotten weaker, but another part of it is from a valuation perspective. They're a lot cheaper. So, why over time has international gotten so, or been so cheap or become so cheap compared to U.S. stocks? Well, you can kind of see a little bit in this chart where the gray line here, this shows global earnings estimates, and the gray line is the U.S. and we have just really dominated from a country standpoint of earnings. Our earnings for our companies, which is one of the most important things to look at when investing, how strong the earnings of a company are. Our earnings from a country standpoint, all the companies that are in our country have gone up significantly. And so that's usually a good thing for stocks, where you can see like China, for example, had gone down for quite a bit of time. And so international had kind of stagnated a little bit for a while. But now you're starting to see, if you look kind of a little bit more over the last few years, they are ascending, and even China as well, which if you take the ascension, the growing in earnings, along with the discount in valuations, that does point to potentially a good performance in that area. Now, back to the kind of the tariff comment and what's been going on with that. I point this out just because there's a lot of noise in the media, and we want to kind of understand what is the environment that we are in from the standpoint of who's charging who amount of tariffs, where are tariffs for other countries versus the US, why is the Trump administration trying to put on all these tariffs. And without trying to avoid any political comment, I just want to say this line right here, this is a little bit confusing, but I'll explain it. The line of reciprocity right here, if we look at this axis is tariffs imposed by the US, and the bottom axis is tariffs imposed on the US. If the country lies below this line, on the right side of that line, they have higher tariffs against the US. So you can see pretty much every example outside of maybe like a Mexico and Singapore, which are pretty close. They charge us more tariffs than we charge them. And so that's some of the issue that the country faces in our deficit, kind of our trading deficit, is that these countries do have an advantage in that their products inside their country that don't have to pay tariffs are much cheaper than the tariffs than the U.S. products that are being exported there. And you can kind of see that if you have something like this happen over a long period of time, our GDP is only made up of 7% exports, because a lot of these countries don't buy from us because it's much more expensive because of the tariffs that are applied on our products. But this chart here on the right is also good for kind of pointing out that if we're looking at who could be most affected by the U.S. raising tariffs, assuming we continue to move forward with that, which is an unknown. But you can see some of these countries like the EU, or that's a region, South Korea, Mexico, Canada, a much larger percentage of those, make up exports, make up a larger part of those countries and those regions' GDP. In the purple area right here would show what are the exports to the U.S. specifically, and obviously Canada and Mexico being our neighbors, export a lot to us. So that's something that we watch and say, okay, if these tariffs do get in place, and right now we're Trump backed off of the reciprocal tariffs, and essentially without getting all the details, we kind of still have the 10% baseline tariff outside of a few products and areas. But in general, we want to kind of monitor this to see which countries are most exposed, and then how to kind of position the money based off of that. Now, if we look at kind of how the market has performed, you can see emerging markets are still right now, and as of this chart, are still slightly down. They're basically flat. Whereas you look at developed markets are up 6.1%. When I say developed international stocks, those markets are up 6.1, whereas the S&P 500 is down 10. So part of that could be because the dollar has gone down quite a bit, and international stocks tend to look more attractive. But another thing is, how these tariffs affect certain countries around the world. So if we look here at this chart, we're looking at basically central banks around the world that are either easing or so are they cutting rates, or are they raising rates? When you're cutting rates, that tends to be more stimulative, whereas when you're raising rates, that tends to be more, it slows down the economy. It's meant to slow down inflation and slow down growth to keep inflation in line. But if this yellow line right here, it says of all the kind of central banks around the world, the major central banks out of the world, what percentage of them are cutting rates and that are easing? And right now it's above 80%. So the majority of the world right now is kind of in this stimulation mode where the central banks are trying to stimulate the economy. When you get above 50%, the all country world index, which would be kind of like the S&P 500, if you will, for the global markets, is up on average 8% per year when you're in that more stimulative environment. Whereas when you're in an environment where countries are raising rates and trying to slow down growth, the returns of the index are closer to 1.37. So definitely a positive backdrop, if you will, a tailwind for the markets, being that central banks are quite a few of them around the world, almost 80% plus, are easing right now. Now, there's been a lot of concerns about the dollar, and understandably so. The dollar has dropped quite a bit recently. I try to put this chart in a little bit more longer term perspective. So I'm using a monthly chart here that goes back about 20 years. And really, if you look since kind of that, right after that 2008 time frame, the dollar, and this is the US dollar index, so this is basically the dollar compared to a lot of the other large currencies around the world. But the dollar has been in an uptrend, and it still maintains this uptrend line right here. However, this is an important line to watch right here, which was a line of support. So you can see really after the Fed kind of raised rates quite a bit to stop the inflation that we were having after the pandemic, when the currencies around the world typically get stronger when their central banks are raising rates. So when the Federal Reserve is raising rates, that's very strong for the dollar. When the Federal Reserve starts cutting rates, that's weaker for a currency, and in this case for the dollar as well. So the strength of a country's currency a lot of times has to do, well, one, it's financial stability, but beyond that, it's the direction of interest rates. And so if interest rates are weakening, that usually weakens your currency. If interest rates are going down, that usually weakens your currency. If interest rates are going up, then it usually strengthens your currency. And you can see from a technical standpoint, this line right here has been a bit of a support. So from a technical analysis standpoint, when you get above kind of some old highs like we had from 2015 to 2020, that was old resistance. Once you break out above it like you do here, that old resistance now becomes new support. So what was a ceiling now becomes a floor. And so when the price comes back down to it, it tends to bounce off of that, as you can see in these instances right here. Well, just recently, the market has dropped down below that support. So that's something we're monitoring closely as well as monitoring this trend line right here. If the dollar does start to go into a new kind of longer term downward trend, then we may need to position even more of our assets into asset classes like gold, into international stocks, into international bonds. So that's something that we are closely monitoring. Now, speaking of gold, we do have a decent sized position in gold in our portfolio, which has really worked out well. It was up 28% this year, and then year to date, it's up 27%. And this chart looks at the S&P 500, actually the other way around, the gold divided by the S&P 500. So when the line is going up, that means gold is outperforming the S&P 500. When the line is going down, that means the S&P 500 is outperforming gold. And I point this out going all the way back to kind of the late 60s, because there's these secular trends. When I use the term secular, that means like a 10 to 15 year time frame. There's these long-term trends that tend to occur. So definitely in the 70s, you can see gold significantly outperformed stocks during that time. But really kind of from 82 to about 2000, that was a big bull market in stocks, and stocks did significantly better than gold. Then you kind of had the tech bubble, you had the financial crisis between 2000 and 2010, gold outperformed during that time. And then really kind of from 2012 up until recently, you had about a 13-year period where stocks outperformed gold, in particular S&P 500 outperformed gold. But just recently, and this is a chart that we've been pointing out quite a bit, just recently, you did have a break from that long-term trend, which could indicate that we're in a new secular long-term trend where gold will outperform the S&P 500. So we already own gold. Another thing to closely monitor, and a big reason why this jumped recently, is because of the drop in the dollar. We continue to monitor the dollar. We continue to monitor a lot of things, but to look to see if, hey, do we need to even add more gold? We currently have an overweighting in gold compared to what we would believe our kind of midpoint or average holding should be in gold. We have an overweighting right now, but there may be reason to overweight it even further. So it's something that we are monitoring. As we look at kind of more from an economic standpoint, the direction of inflation. So, sometimes gold a lot of times will be a hedge against the inflation, but you also have to remember it's also a hedge against the dollar. The dollar falling a lot of times would be considered inflation, but the CPI, the Consumer Price Index, measures the prices of different products. It's another way to measure inflation, and it's the kind of the standard way, if you will, to measure inflation. And you can see since we peaked out around 9% in 2022, it's definitely declined. But the Fed would like to see us below 2% to really cut rates at a fast rate. And we haven't been able to kind of break below that 2%. In fact, we've kind of gone flat there for a little bit. However, over the last couple of readings, you can see the CPI and the core CPI have started to decline again. And so something the Fed would monitor, I bet you, if we start to see that go below that 2%, there's probably would be more of a reason for the Fed to cut rates at a quicker rate. One of the bigger things that makes up the CPI is real estate. And in particular, if you look at it, what's called owner's equivalent rent. So if you basically took every house in America and say, okay, if we were to rent this house out, what would it rent for? That's kind of what's the owner's equivalent rent. And so on average, rent prices, or the owner's equivalent rent price, would go up about 3.2% over time. That would be the kind of the pre-pandemic average. You see it went up a lot after the pandemic, got as high as 8%, but you can see also that it's declined significantly. Still isn't to that long-term average, but because this makes up such a large percentage of the CPI, it's important to monitor this, because this is the largest percentage of someone's budget typically is paying the rent or paying the mortgage. If that is coming down, that puts a little bit of ease, quite a bit of ease on inflation. So this is the different, what kind of makes up our GDP. And I point this out just to say 68% of our GDP is made up from consumption. So the US economy is driven by consumption, by consumers, by people buying things. That has been a big contributor over a long time to our GDP. In fact, in the fourth quarter of 24, 2.7% of our GDP was made up of consumption. So the reason I point that out is because it's important to monitor the consumer. And if the consumer is strong, that tends to be good for U.S. stocks. If the consumer is getting weaker and consumption is likely to decline, that could be bad for stock. So if we look here, and this is one way to kind of monitor consumer strength, if you will, looking at it more from a numerical standpoint, is are they starting to go delinquent, meaning not able to pay on their loans? And you can see auto loans and credit cards, this blue and green line right here, delinquencies have gone up quite a bit over the last few years. And however, some hope here is that you can see there's been a little bit of a rollover on credit card delinquencies not going up as much. And while auto loan delinquencies have not started to decline, they have kind of leveled off. So this is something that we had been pointing out that could be, topping and starting to come back down. We still monitoring that. I'm not convinced that's happened yet, but that is encouraging, if you will. Now, if you look at mortgages, been a steady increase in delinquencies. But if you look at this from a long-term average standpoint, sorry, there's not a straightest line there, but you can see nowhere near the financial crisis. It's still kind of closer to long-term averages, even below long-term averages in terms of delinquencies on mortgages. And then the orange line student loans have a little kind of asterisk down here. That deferment and forbearance on those loans kind of cloud the picture. So it's hard to know exactly how many delinquencies right now are happening in consumer loans, but that's something that we're monitoring as the kind of the deferment and the forbearance. A lot of that starts to go away after some of the policies that were put in place during the pandemic. And then as a whole, household debt service ratio, meaning, what percentage of disposable personal income is going to paying debt. During the financial crisis, one of the highest points of all time, it reached 15.8%. And then after the pandemic, when we got a lot of stimulus, it got one of its lowest points in a long time. We're still at a very healthy level of 11.3%. So the consumers, in some ways that you look at it, could be starting to weaken, although recently kind of improved a little bit. From a higher level standpoint, still not a high debt service ratio. But one other chart that we pointed out in the past, we haven't shown this in a while, but during the pandemic, and it's a little bit of a complicated chart. So the blue line here is the personal savings rate. So kind of from 2008 all the way to 2020, you can kind of see a kind of a slow increase of personal savings. But then you had the pandemic that came around. And during that pandemic, there was there's multiple forms of stimulus, but two major forms of stimulus where families got sent multiple thousands of dollars, sometimes $4,000 or $5,000 per family in the form of stimulus checks. And what that did was that added that helped the consumer by giving them an ample amount of cash, which a lot of that was saved. So personal savings rates spiked significantly. But once that stimulus ran out, and actually this is kind of the cumulative excess of personal savings, this orange line right here, you can see that kind of peaked right before 2022. But as that stimulus went away, now you can see savings rate are below that trend line from before. And you can see the excess savings. We're now right at that point. We're about to run out of all those excess savings from that extra stimulus we got in 2020 and 2021. So when that happens and you no longer have excess savings, that tends to lead to more debt or a curb in spending. So something that we're monitoring. So that's one thing, the consumer and monitoring them. Another thing to look at is the deficit. And this is something that we pointed out quite a bit because in general, this doesn't usually, isn't a pinpoint timing of market conditions, but it's something more that you need to watch for from a longer term standpoint and something that we monitor for a long-term standpoint. If you look at our deficit, and just a quick review of those terms, deficit is sometimes confused with debt. Deficit is if, let's just say, let's use a personal household. If your personal household brings in income of $100,000, but you spend $150,000, you have a $50,000 deficit. You spent $50,000 more than you brought in. So the U.S. economy, the U.S. government spending has a deficit. On average, our deficit kind of runs closer to this 3% line. So meaning the amount that we spend is 3% more than the tax revenues we bring in on average. However, you can see kind of after especially during the pandemic, it jumped up to a really extreme time. But even after the pandemic, we've started to run averages closer to 6.5%, 7%. That is not sustainable for a long term. And what happens, think about back to the personal example, if you spend more than you make, that extra excess deficit goes towards debt. So if you bring in 100,000 in income, spend 150,000, that extra $50,000 deficit, where did that go? That had to go on to debt. And that's what happens with the US or any country, is when you have high deficits, your debt goes up at a faster rate. So this right chart looks at your debt versus the GDP. So it's a way to kind of make it into more of a ratio over time. Sometimes when we hear the numbers $37 trillion in debt, that number seems astronomical, and it is. But you always have to bring it back to, okay, well, what is the GDP to bring it into more of a fair, so you can compare it to past times. And we're at a very high level. In fact, we're right to the highest level we've been as a country in the last 100 years, which is right after World War II. And if we continue to run these deficits, you can see the estimates going above that level. So whether, not trying to say that this I'm for or against this, but when you see like I hate even saying the term doji, but the Department of Government Efficiency and the cuts that they're making, regardless if anyone thinks they're fair or not fair, you can see why there is a sense of urgency to have to cut that. And what happens when you try to cut the deficit? It hurts. Like when you're trying to get out of debt as an individual, and you have to stop going out to eat, and you have to, sell your stuff, sell your cars and all your assets. That's a painful experience, but sometimes you have to go through a painful experience to get back to a balanced budget. And I don't know if we'll ever get back to a balanced budget, but what the government is trying to do is get it back to this 3% level. So something that we're monitoring, because if that doesn't happen and we continue to run these high deficits, as this gets higher and higher, it starts to become less likely that people will trust in the US government from the standpoint of our bonds still maintaining kind of a AAA or high credit rating. All right, so moving along here, if we look at, even though kind of there's been a higher risk of recession, you've seen some of those maybe headlines that there is a higher risk of recession right now. As of now, if we look at the unemployment rate, the job picture is actually kind of, while unemployment started going up in around 2023, it has actually leveled off recently, and we're still at an unemployment rate of 4.2%. It's debatable what is considered full employment, but most economists would say between 4 and 5% would be full employment for an economy. So we still have a strong jobs market in what would be considered full employment as we speak right now. So as we kind of transition into bonds and looking at interest rates, a lot of things that are going on with a lot of the charts that we show will factor in, and it's things that the Fed monitors to know if they should cut rates or not cut rates. And right now, if you look at the blue line here, it's what the Federal Reserve, what the federal funds rate has been at. It's the actual number. And then as you get kind of into the dash line, so like right now we're between 4.25% and 4.5% on the Fed funds rate. As you get into the dash lines, it's what either the FOMC, the Federal Open Market Committee, is projecting, or what the market projects. And so you can see in the most recent reading, the April 11th reading, the market is after, after the stock market and after the economy started looking like it was getting a little bit rocky, then the market believes there's more of a chance that the Fed will cut rates. And so right now, markets are actually projecting 3 to 4 quarter-point rate cuts, which would mean 0.75% to 1% rate cut in 2025. That would be stimulative if rates are coming down. The cost of borrowing would be cheaper. Also, you have to keep in mind, and this is how we look at it from a portfolio management standpoint, bond prices trade inversely to interest rates. So as interest rates are going down, bond prices go up. So that's why bonds have done well this year, and they've gone positive, because if the market expects, or even if the FOMC is projecting that we're going to cut rates, that means interest rates are going to come down, and bond prices tend to do well in that environment. And you can see the difference between what the market expected prior to all the tariffs and all the market volatility in January. They weren't expecting as many rate cuts. But after that, now we're expecting more rate cuts. And so that is something to look at and monitor as in terms of kind of how we position bonds. if we think there's going to be more rate cuts, one, we may overweight bonds. Two, we may go longer term in duration. And then also something that we have done as well as even before the market volatility is went into safer bonds. So U.S. Treasuries, and then we'll get to a slide right here where it kind of shows yields over time. So U.S. Treasuries right now are paying 4.2% versus kind of their long-term median, which is more kind of 2%. So if you see this kind of range, like the 10-year range of where rates have been, and you see where the average is, both for U.S. Treasuries, municipalities, that's a tax equivalent yield, and then investment grade, mortgage backed, these are like Ginnie Mae's and Fannie Mae's. All of these have a much higher yield than their 10-year median yield. So government bonds specifically have been much more attractive from a spread standpoint, but even more so from a compared to their 10-year median. So yields are paying much better now, where you're getting over 5% in a lot of these bonds. So if we look at kind of year to date, where have bonds been? And this is actually as of April 11th. Bonds have actually been a little bit stronger over the last few days. In fact, the aggregate bond index right now is up 2%. But you can just see here the Treasuries, U.S. Treasuries, and the top three right here. Those are the safer bonds. Those have tended to do better versus kind of like high yield, which is higher correlated to stocks. That's been down. So kind of your riskier bonds have gone down this year. Your safer bonds have gone up, which is another reason why we've kind of shifted our portfolio on the bond side to safer bonds, and we did that prior to the drop. So as I finish up here, I just want to kind of talk about from a theoretical standpoint of how to manage portfolios, philosophical standpoint. AllGen tends to focus on managing risk first. That's our philosophy, to manage risk first to avoid any major losses. And so I point this chart out just to say, if your portfolio was to drop 50%, in order to recover, the portfolio has to make 100%. If your portfolio was to drop 90%, your portfolio has to make 900% to get back to break even. So that it becomes exponential. The more you lose, the more you have to gain to get back to where you started. So from a mathematical standpoint, if you're able to manage a portfolio that takes a lower down, meaning a lower loss, a lower downside capture when markets are bad, you don't have to do as well during good times to have a good portfolio that you can even outperform the benchmark over time just by, and I'll show you in this chart, just by having a lower downside capture, which means the market only goes down less than what the benchmark would go down. So this chart gives you a good example of that. The blue line here being the S&P 500, the blue line being a portfolio, the light blue line, this one right here is the S&P 500 invested from 2005 all the way to 2023. But if you were to build a portfolio that would only capture 90% of the downside, which means if the S&P went down 10%, it would only go down 9%. And not even make as much on the upside. So it captured 95% on the upside. So if the market went up 10%, the S&P 500 went up 10%, it would only go up 9.5. If you were able to consistently do that over time, you could outperform the benchmark. Now, obviously, that's in theory, right? And that's easier said than done. But that's the reason. That's why our philosophy is to manage risk first. And so this is just taking an example of one of our portfolios right now, which is our moderately aggressive portfolio. Right now, our moderately aggressive portfolio compared to a moderately aggressive benchmark has about an 80% downside capture and close to a 90% upside capture. So when markets are up 10%, when the moderately aggressive benchmark is up 10%, we're up about 8.9. When the moderately aggressive benchmark is down 10%, we're down about 7.9. So if our portfolios are built in a way where it can hold up better on the downside, two things occur. One, if you can do that and your upside capture is greater than your downside capture, if you can do that over time, you should be able to outperform the benchmark over time. If at the same time, from a psychological standpoint, which is super important, when markets take a big hit and you're scared because you're seeing the news and you're seeing what the S&P 500 is doing, but then you go look in your portfolio and your portfolio is not down nearly as much as what the S&P 500 is down, it puts you at ease a little bit and helps you to stay invested during difficult times. So to wrap this up, and I'm going to apologize for going a little long here, but in general, the intra-year drops, as I pointed out that chart, they're common. So we did have a pretty extraordinary drop over the last couple of weeks, but in general, on an average year, you do have pretty big drops. And since 1980, stocks into the year positive 76% of the time, according to a JP Morgan study, even despite those big drops during the year. So markets do not like uncertainty, and policy uncertainty obviously is pretty high. So we still, even though the market went down, fear is high, there is still most likely going to be a high amount of volatility for the foreseeable future. But many asset classes are still up. Gold's up significantly. International stocks have been doing well. Bonds are up. So this, a lot of times on the news, you only see like the S&P 500, the NASDAQ, Dow, like just U.S. stocks and what they've done. There's other parts that make up a full diversified portfolio that are doing well. And you have to remember, when we build portfolios, and your portfolio, if you're a client, is diversified between a lot of different asset classes. So there are some very attractive yields in fixed income. So we're still, we like bonds and we like the stability of them, but at the same time, they're paying a good interest rate. And on that front, as I pointed out, we have shifted to a little bit longer term on the bonds, but also higher quality on the bonds. So just to sum it all up and hand it over to Paul, I would say, it's super important during this time. People really appreciate having a well-managed, kind of managing risk first type of portfolio. But if you do have questions, we are here for you. Sometimes people just need to hear from an objective voice. So feel free to reach out to your advisor if you want to talk about the details of your portfolio. All right, Paul, you're on.
All right. All right. Well, I know that was a lot of information, Jason. Thank you as always for giving us a high-level perspective on what we see happening. I know we only have a couple minutes left before the end of the session, so feel free to ask some questions. I know a couple have come in. You can type it into the Q&A. As we do that, I want to quickly move on to share a few other resources that we do have for all our people. Of course, we have our blog on our website that talks about different issues. Some are very time specific and to the markets. Others are more general in terms of taxes or strategies or business owner strategies, etc., as well as our YouTube videos. We may talk about health insurance or maximizing 401ks, Roth versus not, etc. Okay, so feel free to use those. Those are on our website or on our YouTube channel. Want to, from a timely perspective, a couple important dates. If it makes sense for you, and if you're not sure, please feel free to reach out to us. Although we have a looming deadline here, the Florida prepaid enrollment. There's only a window every year that you can enroll a child in Florida prepaid, and it's coming to a close here on April 30th. So if this is something that you've talked about with your planner or advisor, or want to talk about it to see if it makes sense, please feel free to reach out. As again, the deadline's coming up here in like the next 13 days, next week and a half or so. Okay. Also, some other tax filing deadlines. If you can go back a second, Manny, thank you. Is the IRS for typically 2 days ago was tax filing deadline, April 15, national, federal tax filing deadline. Some of us who were affected by hurricanes last year, and I say us because it was not just Florida, but some counties, the IRS said, yes, we're going to give you a little bit of an extension. So you have to May 1st to file your taxes. Hopefully you knew that if you haven't filed your taxes, or you may have already filed for an extension, which is the personally petitioned extensions of the personal taxes and business on October and September 15th, relatively speaking. But just in case, some people say, oh, I couldn't get in my contributions in time for my IRA to get a deduction of my Roth. Well, you still technically have till the 1st. So again, about another week and a half to make that happen if you haven't filed your taxes yet. Okay, so that being said, again, we can move on to the next slide, please. We have, financial planning updates. As you guys know, we do financial planning, and the focus typically is on the sensational. The market's down, the market's up, this and that. Okay, and that's important. We focus in on that. But I just read something the other day that if you've got $100,000 and you decide to increase your holdings, by 10% to, let's say in this example, gold. That's great if it's going up, okay? But on $100,000, okay, you just basically increase your portfolio up to $10,000. If that outpaces the market, it might make a difference of $2,000 if it goes up 20%. Okay, at that point, is that really going to make or break you? Now granted, if you got $10 million, that's a different story of 200,000. But all that's saying is where I think the rubber hits the road is, what does your plan say you need to do, okay, from a risk tolerance, and hopefully let that be the steering wheel, if you will, for the decisions that we need to make in life in general. Because I tell people, no one knows what the market's going to do, but we do know where taxes are and are the strategies to save. So if you haven't updated your financial plan, please feel free to call your advisor to make that happen. If you don't have a financial plan, please call us. We'd love to make that happen for you. Okay. Again, next slide, please. This is what our website looks, our planning portal looks like for our clients. You can really customize this for you and really give you a good grasp on the different areas, whether it be college funding. I know I just had one graduate from college last year. That was a picture you saw on the previous slide. From investing to, how much insurance do I need? What is my estate plan? Should it be a trust, or will we get into all those levels of conversations? Okay. Next slide. I also, on a personal note, want you to welcome the newest team member, which is Scott Brewster. Scott came to us with a very diverse background. So I want you to welcome him to the team. I won't read the slide for you right now, but also want you to congratulate him, as he's got a looming wedding coming up here in June. So he and his fiance are getting married in June in an international getaway vacation wedding. So please help me when you see him around, or shoot him a message. Welcome Scott to the AllGen team. Okay. And actually, I'm going to do something that's a little different. I'm going to not post questions. And Dave, thank you for retracting your question. We're happy to chat with you individually about that. But feel free to send us any questions that you have. If we have questions here for you, we'll reach out to you personally to address them. I just want to be sensitive to your time. It is 12:02. Thank you for listening. Hopefully this is helpful and gives you some, at least, peace of mind in the midst of the mayhem. We appreciate you listening, and hopefully we'll see you soon. Have a great rest of your day.